What is up? Okay, so I just wanted to do this quick video and show you a strategy that you can use that doesn't even have a crazy strike rate, but really show you the importance of me showing you this is not so much the strategy, not so much the strike rate, but to show you the numbers. That you don't need a super high strike rate to really grow your account over time. In fact, a lot of Wall Street traders only have anywhere from a 55 to a 65% strike rate as far as winning their trades. And if you're sitting here like, oh, I win 100% of my trades, oh, I win 80% of my trades, you're full of crap, okay? Because you don't. And if you do, your test period is probably like 10 trades. I'm talking 100 trades plus, using the exact same rules, not being subjective, not changing your strategy, using the exact same rules for every trade. How often does it work? That's what I'm talking about. I'm not talking about switching it up to mold to the market. No, black and white. We're going to do this every time. We're going to see if it's profitable. Okay, because that's what the big boys do. Okay, so with that said, we are looking at this strategy. It's very simple. The rules are right here. Our buy conditions are going to be above the 200 moving average with a low cross on the MACD. Okay, and everything is stock. It's actually a simple moving average. It's not even exponential. MACD is just default. Nothing's crazy. So our buy conditions are going to be market number one being above the 200 moving average, indicating an uptrend, right? And then we get a low cross on a MACD. What that's indicating to us is a pullback in whatever the previous trend is. So the low cross being above the 200 moving average is going to indicate to us a pullback in an uptrend. Buy the dips, right? Sell the highs, right? It's the same theory across all of probably economics. So but we're just using this method to exemplify it. So obviously the opposite of that would be our sell conditions, which are going to be below a 200 moving average and then a high cross on the MACD. So if price is trading below a 200 moving average and then we get a high cross on the MACD, what that's going to indicate is a pullback into a downtrend, and we're going to sell into that downtrend. Okay, so that's the strategy. That's basically what we're doing. Okay, so our stops are going to go on a recent high or low, just above, just below, account for the spread. So we're going to add or minus, we're going to add a couple of pips to our stop. I don't think you minus pips for a spread. It's late over here. So we're going to add a couple of pips to our stop to account for the spread. And then our target is going to be percent based. So it's going to be a 50% increase of our risk. That's it. Okay, so we're going to be targeting 50% more than we are risking. Simple as that. Okay, so what we're going to do now is we're just going to go over a couple trade examples. We're not going to go too far into it. I'm not going to show you all 100 trades that we looked at for the test or that could be looked at, because that would take forever. Okay, you can do your own back testing if you want to check the validity of it. Okay. So I'm just going to move these over here and we're just going to look at some trades. So I'm going to move this, make it a little bit easier to see. All right. What we need for a buy, okay? Market trading above the 200 moving average and a low cross on the MACD. Okay, this being our basis line on the MACD right here. That's what I'm using for high cross, low cross, above or below. Okay, so what we need for this buy trade, we are now trading above the 200 moving average. What do we need? We need a pullback, and that's going to be shown to us, one, through price, obviously, but two, through a low cross on our MACD. So we got that right here, right there. Okay, so let's go ahead and mark that out. Ooh, that's a little big. Hang on. Let me skinny that boy up. He's on a diet. There we go. Okay, so we got that right here. It's still kind of wide. I'm trying to see the candle. So we're in a long position. Let's go ahead and we're entering off that candle. Stop below the low, right? A couple pips to account for the spread. So we'll put it right there, right down there, which is great because that's also the 200 moving average. And we're going to have a 1.5 get it target. Okay, so that big candle right there, boom, right off of it. In fact, this, let me just zoom in so I can actually see what I'm doing. Hang on. Don't mind me. Okay, so the low is actually right here, so probably, well, no, that's good. I was just thinking if we should add a couple of more pips to the stop, but we're on a 30-minute, so that's going to be plenty of pips right there. So there's your 1 to 1.5. You can see that candle right there pretty much cleared it for us, okay? So there's an example of a buy trade, okay? We're going to just keep working through and, sorry, I just got a weird text. We're just going to look through some more trades, okay? See if we get another buy. Looks like we did right here. Right there. This one may have been no good. Let's check it out. So we got our cross here. A couple pips below the low. 1 to 1.5 would have been up here. So if you remember, the strategy that we're using for this case study is a 1 to 1.5. So we won one and we lost one, which means we're still up 0.5. Okay, so we're still up 0.5%. All right, let's keep going. All right, now we are trading below. Came back above before we got a high cross, so nothing yet, nothing yet. Need a low cross, came back down below, got our low cross while we're under the 200 moving average, so probably not looking at that until it came back up here. So you could have traded that because it did validify, is that a word? Confirm those rules did play out. Let's just say it that way. Right here, because we got the low cross, we just didn't get it above the 200 moving average until here. Okay, but we are not going to take that trade in this example just because that's a little bit more subjective, and we're trying to keep it black and white, just show you the numbers. But in a real life trading scenario, that's probably something that everyone would have traded. Okay, moving on. This is not really a low cross because you see the orange line never got below the median. Okay. Now here, what are we looking for now? Looking for sell trades. So we need to be below the 200 moving average and looking for a high cross on the MACD. We're below, we're looking for a high cross. That's right there on the line. That's, you know, that's, again, if it's subjective, if it's making you do this and you're like, maybe, then don't take it, okay? If it makes you sit there and think, then don't take it, okay? If it's not obvious and clear, you know, you get enough trade opportunities, and this is just one pair, right? Imagine if you were watching 3 to 5. So you get enough opportunities to be able to be picky. So if you get something weird like that, just don't do it, okay? All right, right here, we did pull back. We are still under the 200 moving average. We got our cross on this candle right here, this guy. Let's mark him out. Okay, boom. So entry on close of that candle, short position, boom, right here, 1 to 1.5, right there. That's actually 5.2, but you know, so as soon as it took off for those candles, boom, done. So now we're up 2% because we've got 1.5% here, and then the remaining 0.5% over here. So we're at a 2% gain. Okay. Now, in reality, what I would probably be doing, and this is how I manage all my trading, if you watch my other videos or the class I just did last night, I think it was, yeah, we just did a big class last night, had a bunch of people on. I showed them how I day trade. And basically I close 50% of my position at target 1 and then trail the rest. So really, in a real life scenario, what would be happening is closing 50% of our position right here, setting a stop to break even, and then trailing the rest, okay, wherever it goes. And but again, we're trying to keep this black and white subjective just for the sake of example to show you the numbers. All right, so we're up 2% in this example. All right, moving on. So we need another high cross. We're not getting in. We're not getting in. This one is technically a high cross right there. But again, that's another one of those situations that you're so close. You're right on the line that you're like sitting there scratching your chin. Maybe not, right? So we'll go ahead and sit on our hands for that one. However, this one here is quite a bit more clear. You see that? So let's mark that guy out. Okay, so entry right there, stop up there, short trade, stop a couple pips above the high, target 1.5. Ooh, is this a loser? I mean, unless you manually close that right down there, that may have been a loser. Okay. Well, actually, let's take a look. Well, no, you would have got in at the close of that candle. So you may have just made it. Just made it, because the close of that candle is your entry candle. And if we take a look at it, I'm nitpicking right now. Don't mind me. So yeah, the close of that candle is your entry right there. All right, I think you get the idea though. Okay. All right. So now we are looking for another high cross, and the unfortunate thing about this is that we are traded above the 200 moving average. So not going to take this for the sake of this example. And again, here wouldn't take this because our orange line never came above the middle. So another situation, just not touching it. Right here, however, we did. So that's a situation that absolutely is tradable with this strategy, and it would look like this. You had your cross candle there, entry at the close of the cross candle. Well, probably confirmation candles in the next one, but for this, we're going to do right here. And at the stop and at 1 to 1.5. But just to keep things crystal clear for you, we're going to make sure we're trading well below the 200 moving average. Like right here. Okay. Another one, stop at the high. Remaining below 200 moving average. 1 to 1.5. Right down in there. Boom. Okay, so I am not even going to tally up the percents because I've actually already done that. It's what I've been doing for the last hour and a half. So, so I'll show you those in a minute. I'm just trying to show you the trading conditions. Right here, very pretty one. We got our cross right here and confirmation candles right there. So entry here. You see that down here? So the cross was actually, these two candles were messing around right there. The two MACD lines didn't start separating until that next candle. So right there. So that at that point is your confirmation. Okay, they did cross. They didn't just touch, they crossed. 1, 2. Oh, whoops. I don't know what I'm doing. There we go. Right there. So came down towards it, almost got it, pulled back, slammed through it. Okay? Just grabbing that pullback. We did both the blue and the orange are actually above the middle line. So that is valid. It's close, but it's valid. It's not as confusing as some of the other examples we saw. So in that case, we got our confirmation candle right here. Probably right there. Right above that high. The wick. You reference the wicks. I know some people and they're like, oh, I don't even look at the wicks. I look at the bodies. And I think that's so, like, excuse me for saying this, but idiotic, because the wicks tell you a lot. Okay. 1 to 1.5. And we got that right there. No problem. Before we rolled over big time. But in fact, so if we use the strategy I mentioned to you previously, where we close half of our position and then set a break even, the remaining half would have been taken out at break even right here before rolling over. But we did get another high cross on that right there, so that actually would have been another trade on the separation candle, which is right there. Right there, that one. Okay, so stop just above here. And shrinking up our target because we have a smaller stop, and voila, just there. So that was actually 2 profitable trades back to back. All right, we are now well below on both, so there's no trade. We came above, we crossed. Ooh, here's a loser. We crossed here, so here's a loser. No matter where you put this stop, it wasn't going to work. All right, so if that was, let's just say 1 to 1.5, somewhere down in there. If you used that, so again, there's no way that you were going to make that work. That was a losing trade. Which is part of the game, because this is actually, let me look at the numbers, only a roughly 62% win rate strategy. So out of 100 trades, 62 were profitable in this case study. So again, now we're just playing around on the 200 moving average, no trade. We got our cross, although it's kind of a cross high and above the 200 moving average. So again, real life scenario, everybody probably would have taken that trade for this example, not going to. Orange never came below. Another cross. Orange came below here. Confirmation candles here. Right there. Yeah, it looks like that is the trade. Whoops, we need a buy trade. Just below the low. I'm looking at this wick right here. And then a 1 to 1.5. There it is, and we actually have to extend this because we got it right there. Almost got it, got it. Okay, so there's another one. And I'm going to show you 2 more because really the strategy itself is not as important as the numbers that I'm going to show you, okay? And we're trying to be as not subjective as possible. Cross low, confirmation candle, here, here. See if that was a winner or a loser. Just below the low. And a loser. Okay. Again, 62%. No, 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 no. No, 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 no. Wow, you can see I did not clear off my whole back test on here. I'm not even going to edit that out. Here, we got to cross here, and we are not below the 200 moving average. So our confirmation candle being this guy right here. Oh, that's bearish, so we'd enter on the bottom. Just below that wick, 1 to 1.5 is right there. Boom. Okay. Show you one more. Here's our cross right here, and done. Okay, right below the low, right at 1 to 1.5. Zoop, right up. Okay, I think you get the idea. So if we look again at the rules, if you want to backtest this yourself, that is the numbers. We'll look at that in a second. The rules, buy conditions are price trading above the 200 moving average and a low cross on the MACD, okay? Sell conditions being price trading below the 200 moving average and a high cross on the MACD. Stops are a recent high or low. Targets are 1 to 1.5% risk reward. Now, ideally, you'd probably be trailing a portion of that or setting 2 targets or targeting previous structure, or one of my personal favorites is if you're trend trading like this, and again, I'm going to do a whole other video on this, so I'm not going to talk about it too much, but if you're trend trading like this, a great little hack of where to get out of the markets is an RSI extreme. So we buy here based on this strategy that I just showed you, right here. This is great for all trend trading strategies, not just the one I'm showing you, okay? So this is where we're in the market. Where do we get out of the market? We get out of the market at RSI extremes, because what tends to happen when the RSI gets extremely overbought or extremely oversold? It tends to bounce, maybe not a lot, but it does a little bit. So it's a great place to take profits when you're trend trading. So when the RSI gets up to one of those extreme levels, we're going to look to book our profits, which was on this candle here. So from here to here was our trade. It's another way to run this. Okay, nice 122 pips. All right, video for another time. Great way to book profits while trend trading. Another time. Let's look at the nuts and bolts. Okay, so in the test period that we just did, not on video, just prior, the start amount, just for easy math, was $10,000, 1 to a 1.5% risk reward. And out of 100 trades, we had 62 trades at 1.5%, so that would be $150. Let's just double check my math. So 62 trades times 150 equals 9,300, correcto mundo. And then we had 38 trades lost at $100, so 38 times 100 equals $3,800 total loss. 9,300 minus 3,800 for our net profit is $5,500, which would be a 55% increase on the account, which is not too bad for a 62% win rate strategy. Now, this is what happens when you're consistent in your rules. When you make the same rules, when you take the same trades with the same rules every time, you're mindful of your money and your management, this is what happens. You do not need a high win rate strategy. You with the right risk management, you could make money on a 32%. In fact, I have a friend who's a Wall Street trader, and he runs an algorithm, and I was just talking to him last week about this. And he has an algorithm that manages some money. It has a 38% win rate, and it makes millions of dollars a year. How is that possible? The risk management. The wins are obviously significantly bigger than the losses. So you do not need a high win rate strategy. You just have to make sure that the numbers are in your favor as far as the risk management. Okay? I wanted to make this video, one, to share that strategy with you if you wanted to try it, but more importantly than the strategy is to explain the numbers game to you. Okay? Because the numbers game, any trader who's doing this full time, any trader that's doing this full time will tell you that the money's made in the numbers game. Not the strategy, not the entry method, not the this, that, or the other. Those can give you an edge, sure, but the consistent long-term profits are made in the numbers game. You need to know your win rate. If you're not back testing your strategy, you shouldn't be testing it. You should back test your strategy, everything. Okay? And try to do it subjectively. Okay? Don't just cherry pick. You know, be like, oh, if I saw that, I wouldn't have taken that. Like, no. Yes, you would have, and you know it. Because you, in that scenario, wouldn't have seen what already happened, right? That's what you're trying to be subjective about. So be as subjective as you can with your back testing. There's even, what really helps with that is this little replay tool in TradingView. If you're not disciplined enough to just be subjective and not cherry pick, then use the replay tool. It's a great way, because then you actually can't see what happened to the right, and it'll really help you with that. So you'll enter the market where you ideally actually would in a live market. Okay, so I could talk forever about that, but again, point of the video was the numbers. You don't need a high win rate strategy. You just have to make sure that the numbers are under control and in your favor. And yeah, it is a cool strategy. It does work. I've traded in a very similar way before, and it does work well. Okay. In fact, the way I trade every day isn't very much higher of a win rate, to be frank with you. It's very similar, and I think it has something like a 67% win rate on the way I trade every day. And the risk reward's a little better though. But again, if you want to try the strategy out, it's very simple rules. I'll show you one more time. Buy conditions being above the 200 moving average with a low cross on the MACD. Sell conditions being below the 200 moving average with a high cross on the MACD. Stops at recent high or low. Target 1 to 1.5% risk reward. Again, you can use the RSI for exits. You can use target or previous structure for exits. However you want to manage that. Trailing stops, up to you. For this case study, for just the sake of the numbers, I did a 1 to 1.5. Okay, so with that, I am going to cut this off, and I'll see you guys later.